Hello everybody, it's Tom Sheridan and Ben Kumar, and we're here to talk about 7IM's portfolio positioning for the second quarter 2018. Now for those of you who are not overly familiar with 7IM, you'll want to know that what we do is we have diversified portfolios, globally diversified portfolios, for different levels of risk. And each one of those levels of risk has a long-term asset allocation, or a starting point, if you will. And then what we can do is we can tilt that depending on what we think the world is that we're looking at the moment. So here we have the equity allocation, which overall is normally about 48%. So you can see that we're a shade under that at the moment. Ben, talk to me a little bit about our equity allocations.
So equities do well in a good global growth environment. And that's what we're seeing at the moment. So we're moving from a large underweight equity to a more normal position, a more neutral position. We think that's where the returns are going to come from over the next year or so.
But haven't we had a very rocky start to the year?
We've had a rocky start to the year, but it's actually been a bit more normal. 2017 was strange. Volatility was so low that it was an oddity. In 2018, volatility's come back, risk has come back, but that's okay for equity markets. That's where you get your return from in the long run.
So there's two things that we might want to talk about then. Which parts of the world do we like for equities? And also, is there something that we can do to protect against some of that volatility?
So looking at regions first of all, we're about neutral most places, but we have a slight tilt to European equity, where there's still a lot of rallying to go to catch up with the US equity market, and a slight tilt towards Japan. Japan's a market that's been unloved and unwatched, frankly, for years, and we think there's some valuation opportunities there. So a slight overweight to Europe and a slight overweight to Japan.
So we've been concerned in general about the withdrawal of QE, about inflationary fears, about rising interest rates, bearing in mind that we've had a very buoyant economic environment to surround all of that. With the volatility that we think we're likely to see from time to time, is there something that we can do?
Normally, a multi-asset portfolio would rely on bonds to dampen that volatility and provide returns. As we'll talk about in a bit, we're not that keen on bonds. What we're doing instead is buying portfolio protection. So we're looking at put options, buying insurance to make sure that the equity volatility, if it's negative, if you see drawdowns, won't hurt customers too much.
So what that will do then is it'll probably take away some of the upside in the portfolios, but help protect customers against some of the sharper drops.
Exactly, smooth the ride.
Okay, and that's very 7IM. Now, normally in a balanced type portfolio, we'd have about 36% in fixed interest, and we've got about 30% at the moment. Can you talk to me about the rationale for that? And where is that 30% and why is it there?
So our underweight to fixed interest comes from the fact that in a rising interest rate environment, bonds don't do that well, and interest rates are starting to rise from really, really low levels. So that explains our underweight. When you look into where we're positioned, we own a little bit of the US Treasury market, still the world's safe haven bond. If you get something nasty out there, a tail risk, US Treasuries will do well.
What's a tail risk?
Tail risk is something you don't see coming. It could be the global financial crisis, it could be something like an earthquake, it could be something like a market panic caused by a trading malfunction. Something you don't see coming that causes people to be scared.
So treasuries then are sort of another form of portfolio insurance then, are they?
Exactly right, and for the first time in a long while, they actually yield something that looks attractive. So it's been a good place to be. Okay,
so we have our slightly less than normal equity position with a bit of portfolio protection. We've got our more or less than normal, if I can put it that way, fixed income position, also with a bit of cautionary protection in there. And to replace some of the job that gilts would normally have done in the portfolio, as we have spoken about in previous quarters, we have our alternative section of the portfolio. Talk to me a little bit about what's in there.
So the alternatives are there to provide a return stream that is diversified, not connected to either the equity part or the bond part. If you think about bonds, they used to do well in bad situations and pay you a yield. That's not been the case for the past few years. So with our alternatives positioning, we're looking to try and generate a low volatility return from some of the more niche market strategies. We do a lot of due diligence to make sure that these kind of absolute return style strategies are correct for the portfolios, and then we put them in place.
So they tend not to behave like equities and they tend not to behave like fixed income, is that it?
Exactly right. A diversifier, no correlation.
Okay. So cash.
Yeah, we've got a low amount of cash because of these alternative strategies, to be honest. If you can find somewhere to put that cash that generates you a low volatility return, we think that's what our investors pay us for.
Okay. So what kind of return would a customer expect over the long run in a balanced type portfolio?
Around 6.5% over the long run for a balanced portfolio is what we're trying to achieve.
And over the last decade or so, is that more or less what they've been doing?
Around 6.5% over the last 10 years is what our balanced portfolio has achieved.
Okay. Well, Ben, thank you very much, and thank you very much for listening. And for those of you who would like even more detail on the positioning inside the portfolios, please do get a hold of your 7IM relationship manager. Thank you very much.